Okay, now this helps us to understand some numbers that I threw out in previous parts of this talk. How does a venture capital fund work? And once we understand that, then we'll understand more investors, parameters for our companies, and also what we need to do to make sure everybody makes money. So a venture capital fund raises money from investors. There are different types of investors in startup companies. The two biggest categories are angel investors and venture capital investors. Angel investors invest their own money, and venture capital investors invest other people's money, plus some of their own usually. So in this case, the venture capital fund is raising money from their fund investors. They take this money and they invest in companies. In my simple model here, they took $10 million and they invested in 10 companies. Average of $1 million per company. Oh, actually a little less, but average of $1 million per company. Now, the fund size, therefore, is $10 million. The lifetime of this fund is 7 years. Management fee, which is an annual fee paid by fund investors, is 2.5. This gives the fund $8.2 million to invest. So they invest this in 8 companies, and then out of these companies, we get 4 companies that fail, 2 companies that break even, and 2 companies that exit. Exit means either sell to another company in a trade sale or list in an IPO. Now, these numbers are not just imagined. When we look at real statistics for failure rates and success rates for new companies, like what percentage of new companies fail?
90.
Yeah, so this is like a very common statistic. You know, we hear 90% of new companies fail, or only 10% of new companies succeed. Which I think this is one of those like internet statistics that if you go and try to find the real data underlying this statistic, you're not going to find. And the reason is, this is a very difficult question to measure. Like, when I say, let's say I try to answer the question, what percent of new companies fail? What does it mean? Or when has the company failed? When do we start counting and when do we stop counting? And what constitutes a new company? Is it a company that's registered? Is it a company that actually commences business? Is it a company that actually starts selling? So I try to stay away from that statistic, but I have some real statistics on percentage of venture-funded companies and the return that they deliver to their investors. And this comes from a large and credible data set that's collected by researchers in the US. Now, again, okay, I'm using US numbers because why? This is where we have a real data set that stretches back 40 years and that covers a big universe of funds. But I'll talk later about our experience in Singapore, and our numbers are not that different from US numbers. So I believe overall this is also the case. We can extrapolate from US numbers to expected results in Southeast Asia. Okay, so for venture-funded companies in the US, in the data set that we have, we see about half will fail, meaning fail to deliver any return, meaning the return on that investment is minus the investment amount. So return 0. So we invest 1 million, we get back 0. Another about 16% will deliver, 16-17% will deliver less than 1 time the return, which means we invest 1 million and we get back less than 1 million. Now in venture capital accounting, if we get back anything, we say it's less than 1 time the return. So if we invest 1 million in a company and later we sell the furniture for $100, we got back 100, so it wasn't 0. It was less than 1 time. So therefore I'm going to lump those two together and I'm going to say 0 or less than 1 is the same. So this is about 2/3. So we see that about 2/3 of venture-funded companies in our data either return 0 or less than 1 time, which I'm going to define as fail. But that means 1/3 succeed. 1/3 succeed to deliver more than 1 time of the investment, which is actually pretty good, and it's very different from 1 in 10 succeed. So this is the numbers we're going to work with, and we can see that in my example fund it's pretty close to that. Because the sample is so small, we only have 2 companies succeed. But I have 75% fail or break even, and those 2 companies that succeed therefore have to drive all the return to my investors. So in a venture capital fund, if you're an investor in a venture capital fund, what type of return do you want? What would be a satisfactory return for you as an investor in an early stage venture fund? Yeah, probably you want 30 to 40% if you're really investing in a fund that invests in seed stage like we do. So that's what we do in this model. We deliver 35%. Now, how do we do that? We have to deliver 35% per year over 7 years, although our returns are driven solely by 2 companies. And this is exactly how it works in real life. The vast majority of returns in venture capital funds are driven by 1 or 2 successful companies. This means that the return on those companies needs to make up for the losses of all the other investments. And that's where I got my 30 times number before. I mentioned I need 30x at this stage. Why? Because in this case, once we work the numbers, we see in order to deliver the investor in our fund required return, given our expected failure rates, each successful investment has to generate 28 times the original investment. So approximately 30. That's why I say this is an acceptable level for this stage of investment. If we can deliver 30x return on our 2 successful companies, then we can pay our investors their required return, and then everybody is happy. Companies are happy, we're happy, and our investors are happy. And of course, in this business, like all other businesses, we strive for everybody to be happy.